one of the trickiest and potentially most costly parts of doing a Roth conversion is something that few people are aware of until it's too late. They do the Roth conversion, then they see the impact later, and they say, I had no idea it was going to impact this, but now it's too late. I don't want to see that happen to you. I've been a financial advisor now for over 20 years. I've seen potential clients come in, people that are thinking of working with me, and they share with me what they've done in the past and not realizing the impact it was going to have on them. And I don't want to see that happen to you. So in today's video, I'm going to share with you what it is and give you some information to help you make an informed decision, including this factor. So what is this mysterious factor that people don't think about? Believe it or not, it's the cost of your healthcare insurance. And whether you're before Medicare, let's say you're retiring in your 50s, and so you're looking at the Affordable Care Act subsidies and how Roth conversions may impact you there, or whether you're over 65 or soon to be 65 and you're on Medicare and you didn't realize that you could potentially impact and dramatically increase the premium that you have to pay on Medicare. It's called IRMAA. We'll get to that later, but first, let's jump into the Affordable Care Act subsidies and how a Roth conversion can impact you. So most of us know doing a Roth conversion is taking a regular IRA, a regular 401k, and converting that into a Roth version of the IRAs. And the reason people do that is to avoid required minimum distributions. Because as we get older, those required minimum distributions can force us to take out enough money from a regular 401k or a regular IRA that it puts us in a high tax bracket. So when we do a Roth conversion, we have to pay the tax on that, but importantly, it also impacts what's called our adjusted gross income, our taxable income. So not only does it impact how much taxes that we have to pay, but because it impacts our AGI, our adjusted gross income, it can impact other things such as Affordable Care Act subsidy. So from the tax standpoint, just high level, if you can do a Roth conversion and keep your total taxable income in the 10 or 12% tax bracket, for most people that's a fairly low federal tax bracket. And for a lot of people it makes sense. This is not financial advice for you. I don't know your specific situation, but I want to give you some guidelines to think about. I do encourage you to work with a financial advisor or an accountant to help you out. But there's 7 tax brackets in the United States. And I want to show you this quickly. The 2 lowest brackets are 10 and 12%. And you can see the 12% bracket for a single filer goes up to $47,150 and to almost $100,000 to $94,300 for married filing jointly. But it's really important to look at this next line. The next line is that tax bracket jumps to 22%. Then it goes to 24, and then there's another big jump from 24 to 32. So it's those breaks, the 12% to 22, keeping those dollars below the higher tax brackets is something that you want to look at. Now, not every dollar of taxable income is going to be taxed. We have either an itemized or a standard deduction. Most Americans are going to use the standard deduction, which if you're single, basically says in 2024, the first $14,600 of adjusted gross income is essentially going to be reduced by this standard deduction, and your taxable income will go down to 0, right? If it's taxable income is below this standard deduction. Same thing with married filing jointly. If you're married and you file jointly, you and your spouse have $29,200. So really the way to think about it is that first $29,200 gets erased by this itemized deduction. And then those dollars we saw in the tax bracket, the $47,150 for single people and $94,300, which is the top end of the tax bracket, those are dollars above and beyond that standard deduction, and some people will itemize. Okay, so that's how the tax portion of a Roth conversion works. But I also want to go through what happens with the Affordable Care Act. Now, many of us don't know what our subsidy is going to be under the Affordable Care Act. Unfortunately, the Kaiser Family Foundation has a really useful website. If you go to kff.org, you can see the website here on the image. And essentially you put in your state, you put in your zip code, and then in this case I put in a hypothetical family's income of $50,000 for a married couple with 2 people. And you can see they're 60 years old, so they're not on Medicare yet. They have no children. And the Kaiser Family Foundation would say that the subsidy is $1,688 a month, or a little over $20,000 a year. Now, it does depend on where you live. I put in the same data with California. And here, California has obviously a much higher cost of living. And so the subsidy would be a little higher, almost $25,000 a year. So this is what's at risk. If you do a Roth conversion and you don't take into account the Affordable Care Act subsidies, this is money you could be giving up, $25,000 a year if you live in California in a subsidy. I also put in $150,000 just to show you another example here in Utah. And there it's almost $10,000 a year. Let's go back to California, and there it's almost $15,000 a year. So this is what potentially could be put at risk by doing Roth conversions without thinking about this, because the Affordable Care Act is taking taxable income into account, and that includes Roth conversions. Now, I'm not an accountant, and I don't know your situation. This is not financial advice for you, but I want to put this on your radar screen so you're aware doing a Roth conversion could impact the Affordable Care Act subsidy that you get. Okay, so that's for people that are not on Medicare, but many of you might be thinking, well, that's good to know, Azul. Thanks for the information, but I'm good. I'm on Medicare. Well, not so fast, because the Medicare premiums can be impacted. The Part B, as in boy, and D as in dog, can be impacted also by your taxable income. And that's called your IRMAA. It's essentially if you make too much money, income-related modified adjustment, something like that. And you can see here, if you're married and filing jointly, you can make up to $206,000. But what if you did a big Roth conversion? You can see if married filing jointly, $258,000 to $322,000. Now your Medicare Part B, and Medicare Part B, just as a reminder, that your medical insurance. So Part A is your hospital. It's not going to impact that. But it could impact your Medicare Part B, which is your medical insurance, your doctor visits, and Part D, which is your drug coverage. Okay, so this is the IRMAA premium that you may have to pay extra. This table goes through it, but you can see it's up to, potentially between Part B and Part D, an extra $500 a month. So these are things in addition to the taxable income that I want you to be aware of when you're doing a Roth conversion. Now, does that mean a Roth conversion does not make sense? No, I'm not saying that at all. I'm just saying this is another thing that you have to factor in. And oftentimes what happens is when people first retire is they have the ability now for the first time in their life, right? For most of us, our W-2 income's gone. If you have a pension, you're still going to have W-2 income from that pension. But until we start collecting our Social Security, we have no income coming in. And so oftentimes people are like, woohoo, I've got no income. I'm going to pay $0 in federal tax. Well, unfortunately, what they're doing is they're giving up those 2 lower tax brackets. You want to fill up those lower tax brackets, or you want to consider doing that, the 10% and the 12%. Use that every year, and you can consider doing a Roth conversion if you have no other income, right? Because there's a fair amount of money that you can convert and not trigger and not go above the 12% tax bracket. But you also have to look at how's that going to impact your subsidy. So things are much more complex. And rather than do this in your 60s, if you're watching this video in your 40s or 50s, really think about looking at your savings and which buckets your money is in. Is it in a regular IRA, a regular 401k? Is it in a Roth version of those? Is it in a regular taxable bank account? Those are the 3 main buckets. You likely want some money in each of those buckets so that you can control what tax rate that you're in. If all of your money's in, unfortunately, a regular IRA or a regular 401k, you don't have a choice. Every month when you take money out for your monthly living expenses, you're going to triggering taxable income. Now, what rate you're going to pay on that depends on your situation. But if instead of all of your money in one bucket, the regular IRA, the regular 401k, if instead of that you have some money in each of these buckets, then you can look and say, you can be strategic. And this can result in tens of thousands of dollars in tax savings if you can strategically, continuously fill up those lower federal tax brackets, the 10 and 12%. If you can be strategic about how your health care, your ACA, Affordable Care Act subsidy is going to be impacted, if you can be strategic about your IRMAA impact and your Medicare Part B and Part D, now you have a lot of control. And between those levers, you can dramatically lower things. So I think it makes sense as you're putting money in. Yes, you can do Roth conversions later, but I do think as you're putting money in, it makes sense to think about this. As Stephen Covey said in 7 Habits of Highly Successful People, begin with the end in mind. And you want to be thinking about when you are in your 60s and you're taking money out, or your 70s, what's the tax situation going to be? And oftentimes, instead of doing the conversion, it's better to be thinking about how you want those accounts to be at the end, and then contribute money into those accounts based on that. Now, one thing that people get confused by that I think is really important, and that is if your tax rate is the same the day you put money into an IRA and the day you take it out, in theory, you are indifferent between having that money in a regular IRA and a Roth IRA. Let me give you an example. Let's say you put $1,000 in a regular IRA. Let's say you're in the 20% tax bracket. So regular IRA, you put $1,000 in. 10 years later, you have $2,000. You're over 59 and a half. You withdraw that money. If you were in the 20% tax bracket at the beginning, right, you didn't pay any tax, so you got the full $1,000. 10 years later, it's doubled. Now you have $2,000. You pay your 20% tax bracket. Tax rate on that, you have $1,600. You paid $400 in taxes. Now, let's go back 10 years, but instead of do a regular IRA, let's put that same $1,000 into a Roth IRA. Now, in this case, we pay tax on the way in. So the 20% tax bracket, we have $800 in our Roth IRA. But the nice thing is this grows tax-free, and when we take it out, it's tax-free. So now we have $800. It doubles over the next 10 years. Which is $1,600. We take it out. What's the tax on it? It's nothing, right? There's no tax owed on it because it's in a Roth. So now it's $1,600. So they are the same. However, hopefully through this video you've seen where even though you're indifferent from a federal and overall income tax standpoint, as long as those stay the same, you may not be indifferent from a Affordable Care Act impact for your health insurance if you retire before 65, before you're on Medicare. And you may not be indifferent from an IRMAA standpoint for the additional premium that you might have to pay for Part B and Part D, which is why it's so important to be strategic about these accounts. I think it makes sense because of the dollars involved. I mean, it's literally could be tens of thousands of dollars on the distribution by taking money out in the right order and being tax conscious about it. I think it makes a lot of sense to have an accountant or a financial advisor look at your specific situation and come up with a game plan for you. There's some really powerful software that financial advisors and accountants have where not only can they tell you what the game plan is and what the strategy is where you pay the least amount of money over a lifetime, but they can show you illustrations that'll make it perfectly clear why it makes more sense. And it really has a lot to do with that 10% and 12% bracket. Filling those up in the early years. Would you rather take money out at $1,000 at a 12% tax rate in your 60s? Or would you rather take that $1,000 out as part of a required minimum distribution where maybe now you have to pay that 22 or 24% rate, right? Obviously, you want to pay the lower rate. So that's the way it works. I hope you enjoyed this video. If you did, I think you'll also enjoy this video here where I talk about what the average American receives, what their income is in retirement. Average American income in retirement. Thanks for watching this video, and I'll see you in that one. Bye-bye.